Good morning, everybody. This is Kirk Spano, August 24th, morning edition of Ask Me Anything, mainly because I'm taking clients to the Brewers game tonight. We had originally not had anything scheduled today, but I thought I'd throw it in, take a few questions, go over a few things that I have been looking at and thought you might be interested. So why don't we just start with couple of articles that I've written in the last week. First one, stocks of the week, just last night. Deep discussion about On Track. So I think you should read that. One of the lessons that I've learned is that when a company is getting priced for Armageddon, and you can surmise that they aren't going to die, that they aren't going to go out of business, they aren't going to get wiped out somehow, you should probably buy the stock. And we've seen this lesson over and over again. It's easiest when there's a big correlated correction and the Fed is going to pump up all ships. We are probably on the other side of that now. The Fed is probably not going to be too helpful in the not too distant future, at least less helpful. Teresa posted an article this morning about quant factors flowing through the Treasury. And as I said, 2 or 3 weeks ago, liquidity conditions are already tightening up a little bit to the point where margin fell just a little bit, but not enough to really crush the market. And I think words like crush or crash or getting pummeled are bad words to use in general because it implies an emotional response. We want to look at things mathematically. And I think that if you look at companies like On Track or some of the other meme stocks or the SPACs or the oil companies a couple of years ago, it should be very easy for you to appreciate that stocks can fall 50, 60, 70, 80, 90%, and it's not even that hard for it to happen. The thinness of the stock market across most of the stocks out there, the thinness of the trading support of the strong-handed investors across the market just doesn't exist, except in your 50 or 60 stocks that have been carrying the market for the last couple of years. In particular, your cash cows on the NASDAQ 100, your Microsoft, Google, Apple, Facebook. Throw in Amazon, even though they're not super cash rich, they have great cash flow. And a handful of other companies. When you take a look at the NASDAQ 100, in particular, the I believe it's 30 or 40 biggest companies, top half in particular, and you take a look at the cash on their balance sheets, you go, whoa, that's most of the cash on all the corporate balance sheets in America. There's this idea that corporate balance sheets are in great shape because they got to stretch out their debt. Well, yeah, they got to stretch out their debt. They got to lower their interest rate a little bit, but they still have a lot of debt. And at some point, the market's going to ask, hey, when are you going to pay this off? And companies that have growth problems that are being disrupted are going to get wiped out. And the bondholders will end up owning the stock in the post-bankruptcy versions of those companies. I've said there's at least 100 of those in the S&P 500, and I think it's higher. I think it's at least 150, and it might be 200. Hard to know. Managements can change things. They can turn certain ships around, but a lot of them end up being the Titanic. So when we take a look at stocks like On Track, and this is not popping out, so let's do that. What we see is a bottoming process. It broke through a major support. And so the question you should ask is why? Is this company going out of business? Clearly not. They've got about 100% growth rate, even with defections from Aetna and Cigna. And I talked about OnTrack a few weeks ago, and I said, look, future of OnTrack is not in the big insurance companies. Why? Because the big insurance companies have the capital to invest in their own internal system that's like OnTrack's. It's your smaller insurance companies, your corporate healthcare systems, your unions, your government entities that need OnTrack because they're not going to do this on their own. So Cigna invested in a company called Ginger, which is essentially similar to OnTrack, but designed to work for Cigna. I'm not sure if that's what Aetna did, but Aetna did move their operations essentially in-house. United Healthcare is in-house. Anthem is a combination of in-house and outsourced. And Humana still works with OnTrack. And I've got a feeling that Humana and OnTrack might get a lot closer. We'll see. Of the companies in the tech space that are in this field, Microsoft is the one that you take a look at and you say, they want to get into this space. Will they build it from the ground up? Will they acquire somebody? Or will it be a combination of both? What about Google? What about Apple? What about Facebook? So the combination of technology companies getting into these spaces is going to do two things. One, it'll compress margins a little bit, but it also is going to facilitate mergers and acquisitions activity. So I would think that OnTrack is probably one of the handful of survivors, along with the insurance companies' internal systems and some of the big tech companies that have the cash piles to expand. But remember, they're running into antitrust issues. What you might see with a company like OnTrack, and Microsoft is a company that does this sort of thing, it's just a big investment in the company. Maybe Microsoft goes to the chairman of this company who owns 49% of it. And he says, hey, Mr. Peaser, why don't we help you sell some of your shares without having to sell it into the public market? Why don't we do a private party transaction between Microsoft and the chairman and say we'll buy 20% of the company, or whatever it is you want to give up. We'll make a strategic investment. And by the way, you'll start using the Microsoft cloud, and we'll start migrating people to all Microsoft systems instead of Google. These are the types of deals that we've already seen with Microsoft. So when I say it's interesting that Microsoft is a player here, I think I've got a pretty good track record of discussing companies and what their actions might be in the future. So at around 10 or 11 bucks a share, I didn't look at it today yet. If you don't have a position in OnTrack, you should probably get one. And if you do, this is finally a spot where you can average down. I, of course, averaged down in here once already. I rolled out my puts, and I'm looking at selling more puts down here. I have to take a look at exactly how I'm structured. It might make sense for me to sell more puts versus buy the shares. We'll see. Or I could just keep rolling out the puts that I have and buy shares. But it's already a full position for me. So I don't really want to get past the full position. I don't see this as a double position stock, but you have to manage your full position here. And then if it runs up to here, which is what I have said I think is likely, then we can trim in here and see if it keeps running. See what's going on at the time. Covered Ajax and Kazoo again. I mean, you really need to take a look at what Carvana did. Kazoo's addressable market is similar in Europe, but it's a little bit bigger. And they're the only one doing it right now. This Ajax is, once it's trading under its new symbol down the road, and institutions start to take a look at these companies just as companies, there's going to be a lot of investment. And the float is small. So it won't take much investment from institutions to drive this stock up 50, 100, 200, 300%. That's just something you have to keep in mind. Companies with low floats are easy to short if there's not a lot of interest, but they're also really easy to drive up. Think about all those penny stocks out there that some of the websites tout. They buy a position, they send out 1 million messages, and then they sell into the strength and say, look, we picked another winner. Meanwhile, the last 40, 50, 60% of the people who bought that stock are screwed. New Fortress Energy, I want you to read this. It's got a weekly RSI of 35. Their LNG projects are important, but they're transitional. And their renewable fuels and their hydrogen projects, I think, are going to be a big deal. The guy who runs this company is Wes Edens, also one of the owners of the Bucks, guy who brought you Giannis. And he was one of the partners over at Fortress Investments, which got bought by SoftBank. Wes Edens is some sort of weird savant, and he's done similar projects to this before, where he cobbles something together, directs it, sells off the non-core assets to fund the part he wants to keep. And that's what they're going to do here. So they've made some acquisitions. They're going to sell off the non-core pieces in a year or two. Probably going to sell off the LNG assets eventually. And along the way, he's going to spit out a bunch of cash. That's how he makes his money. He's got a big, big share in this company. So I'm looking for a way to enter New Fortress Energy because I know how this is going to turn out. At some point, there's going to be spin-offs involved, and then eventually a standalone company that probably has first mover advantage in some key markets. One thing to think about with alternative energies, yeah, I do think one of the charts that come over, let me grab it from over here, that this is true. Most fuels will have to be replaced. That's why I like Amidas, with carbon capture and the zero carbon footprint for renewable diesel. This company is focusing on electricity with the LNG right now, but is getting into everything else. If we're going to see up to 99% of the energy system disrupted, we need to be in the disruptors. This is one of them. And it's dirt cheap. Went through the stock screener this week, and I just have the S&P 500 here. And you want to take a look at all the stocks that are with a weekly RSI under 30. There you go. That's the one. There's one. There's one stock under 30, and then a small basket in the 30s. There's almost nothing that's oversold. AT&T flirts with it. Amgen, Newmont. Somebody asked about gold miners, so I thought I'd show you Newmont. Earlier in the month or last month, I talked about the 0.786 lines all being in play on a correction. Sure seems like that's true. In a stronger market, the 618 lines would hold. In this market, I think a lot of 786 lines. And that coincides with this whole jitterbug area that reemerges here. So I'm looking for Newmont close to 40. Gold miners was thinking they'd hold the 618 line. I'm not so sure anymore. I think for sure it gets down to middle 20s. And I'm taking the cue from Shooter that we see lower. I'd have a hard time not loading up at 23, 24. Something pretty bad would have to happen for it to go down into this zone. Because where Shooter is talking about. So could this little truck get moved down here? It could. And I'd have a hard time seeing these companies go that low, but in a weak market, it could happen. Especially if the dollar gets strong, people panic. I haven't looked at semiconductors in a while, so I pulled up Micron, adjusted the chart, updated it. Looks like it'll get into the lower 60s for sure. It could get all the way down to the lower 40s, I think. So keep an eye on the semiconductors, because one of the things that's happening is that slowly but surely the supply chains are moving, and Taiwan Semiconductor isn't the only game in town. These guys, this little company, call themselves Intel. Not a sexy stock, right? But it does pay to buy it anytime it gets into the 40s. And they are going to be a competitor to Taiwan Semiconductor in the next few years. So as the supply chains slowly catch up and move, and Intel starts putting more resources in, and the government throws $50 billion at the semiconductor shortage, the semiconductor problems should alleviate in the next 18 months. But the market will adjust before that. So this huge run that we've seen in semiconductors is probably overdone. I don't know that NVIDIA deal is going to go through. So we have to be real careful about ETFs like SOX that have just run straight up. But you can see struggling to advance now. And now you got a big confluence right there. Huge binds really starts down around 300. The lower 300s on SOX, I think, is in play. That'd be a 30% drop, which is not an uncommon thing. And if liquidity really tightens up even more, the dollar gets a little stronger, you could have one of these unusual buying opportunities. Somebody asks, what do I think about what's going on with China and the impact on Taiwan Semiconductor and the fact that they have a drought over there? Guess that's what he's asking about, drought. I didn't even know that. Here's what I think. I think that the biggest flashpoint in the world is Taiwan. And I think the fact that we've flown military jets over there in the last couple of years is scary. And it means that either we're just going to drop troops there and say, you really don't want to come here to China, or we have to negotiate something so that China never ever invades, that they really honor the two systems, one country, two systems. They didn't honor it with Hong Kong, right? Hong Kong doesn't have its own system anymore, but they're basically on land, right? Taiwan's an island. I don't know what the great leaders are going to decide. And as I said a long time ago, I'm not in love with Joe Biden. I think he's better than Donald Trump. But, I don't know where Biden's trying to take us right now. Because the way that he handled Afghanistan was not the way I would have done it. I would have essentially ringed Kabul and told the Taliban, don't get anywhere close till August 31st. And I would have flown 300,000 people out of there. And I would have gotten all of our equipment out. And I would have blown up anything that was sensitive. I don't have the highest confidence that Taiwan is going to work out well in the next few years. But I also don't have a lot of fear that we're going to have World War III. But I do think Taiwan Semiconductor is just going to face competition. I mean, there's no doubt that we're trying to move supply chains home. This has been a topic that I've been talking about for almost 5 years now. And eventually Intel and somebody else, probably 3 or 4 companies, will finally be competing with Taiwan Semiconductor. But Intel is going to be the big one. So if we can get a chance to buy Intel on the cheap, especially if you're a dividend investor, you're going to want to do that. I mean, if you're a dividend investor and you can get Intel close to 40, you should jump all over it. All right. We'll get back to some of these questions here in a minute. I was scanning the S&P 500. Came up on Las Vegas Sands. Remember, we've talked about the Venetian getting sold. Well, this is who sold the Venetian. And they are betting on Southeast Asian gambling and online gambling. I think those are both pretty good bets. So if this dives off, and I'm going to do the rest of the research, if this heads into the 20s again, we really have to look at this one, because then we have another cheap gambling stock that probably does really well. Caesars, another one that I'm looking at. They've recently become asset light. This comes all the way down back into here. I think we have to take a look at it. In fact, this all the way down to this confluence. Confluence in here. Confluence meaning multiple levels kind of confirming themselves. 618 line down to this. And a lot of buying pressure there. Lines with where this jitterbugged. So Caesars, if it gets down to this jitterbug level, I think we have to be pretty serious about wanting to be involved with it. Dave Zanoni wrote an article on his page, so you should take a look at that. He's no longer working with us, by the way. He just he's got a real job, got a regular job, and didn't have a lot of time for this. So, I let him keep the free membership, and hopefully he touches base from time to time, and he's writing articles on his own. So we'll see him from time to time, but for the most part, it's just me and Dividend Sleuth and Shooter now, and we have potential another edition coming. But I've just tried to upgrade to folks who are doing this more regularly. MGM just sold off their assets to Vici as well. So they're also going asset light. So these are all charts that need to be a whole asset light model, right? They're all doing it. And it's weird to some people that they got rid of their real estate. They're like, oh, I love real estate. Well, won't you love to not have to pay any bills and just pay a little rent and have money flow in from degenerate gamblers? So you can see MGM way down in the 20s on a correction. Probably be worth looking at that one. Might even have to take a look at a gambling ETF. Now that basically the strip is owned by one company. Of course, Fast Management, Fast Acquisition, which is going to become Fertitta. If you don't have a position in this, you're just not listening. They just got 10 million shares of DraftKings by selling Golden Nugget Online to DraftKings. So Fertitta Entertainment owns over 10 million shares of DraftKings now. No, you could just buy DraftKings, but from an arbitrage standpoint, the shares are super undervalued here. So you're getting the DraftKings shares cheap. It's just like with Liberty Sirius. Liberty Sirius, you're not paying for a bunch of assets, you're just paying for Sirius. So when somebody wants to give me free money, I tend to say, how much can you give me? A Shooter will tell you, because there's not a lot of history here, just not a good way to know how low it can go. But if we take a look at some of the other former SPACs, I'm going to call it a former SPAC. It's not a SPAC anymore. They got a deal. Round trips aren't out of the ordinary. And if people redeem, which they're past that point now, right, it can go a little lower. But they're above 10. They've held it. Not a lot of risk of this company really diving off. It could go tink, 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 tink. It sure could if the market's weak. But I think this is like one of the best ones to sell puts on. There's just not much downside. And again, they've got the online thing. They've got the casinos, but they're not super asset heavy, right? They only got a handful of casinos. And then they have the restaurants. They're sitting on a pile of cash waiting to expand, but they're taking their time. Why? Nobody to work in the restaurants right now anyway. Common around the country. I think a lot of restaurants are having a problem keeping the doors open, keeping staff on, especially places that focus on eat in. But at some point, this company with all those great restaurants, when that finally comes back, this is a company to be involved with. But the gambling, right? I mean, just telling you, it's an addictive behavior. It's not going away. It's very recession proof. Somebody asked what to do with Soaring Eagle. Buy more. Here's one of Kathy Wood's favorites. Right, chopping along. It's a biotech company. I think that in this space, which is DNA, it's got to the moon potential. Could it go down a buck or two? For sure. Between buying shares and selling puts, I think you should be doing it. Again, I know that people want to say, well, but it's not Microsoft. Yeah, I get it. Small companies become big companies. If you have a basket of small companies and 50% of them chop along and half of what's left are just market performers, but the rest go through the roof, you're way, way, way ahead. So people are asking me, should I tender my shares? No, you shouldn't tender your shares. We bought these because we want to own these. These are long-term holdings. Leave them alone. Stop trading short-term on things that you bought for what's going to happen in 2 or 3 or 4 years. You want to trade Microsoft because it's overvalued. Or Amazon. Those are the stocks that you trend trade at this point, and you better have a really good parachute. The large cap stocks are where the problems are, not the small cap stocks. When smart money starts coming off the sidelines again, which will happen about 8 minutes after the next correction, they already have their targets. I'm telling you what a lot of their targets are. I know this because I talk to hedge fund people. You want to buy these stocks that are beaten up, the baby's thrown out with the bathwater. But SPACs. Shut up. If you don't understand what you're talking about, shut up and listen. A SPAC that has a deal is different than a SPAC that doesn't have a deal. And a SPAC with a good deal is much different than a SPAC with a bad deal. And we have to consider that there's always going to be 20 or 30 or 50% dilution down the road. And that's why we wait for these stocks to get around 10 bucks, because then at least they're trading for about cash value. And we're not involved with any of the companies with heavy redemption. There was an article in Bloomberg that showed the companies with heavy redemption. None of those are ours. Trust the process. Got over 20 10-baggers in my career, and one of them did it twice. You're never, ever really going to do much better than beating inflation as a stock investor unless you buy small cap stocks. It's a fact. You have to buy small companies that are going to become big companies. And you find the ones that aren't speculative. Companies that are already making money. Soaring Eagle has revenue. So the story on HRTX, somebody asked about Heron Pharmaceuticals, therapeutics. So now we get to talk about Afghanistan again. What's the number one export product from Afghanistan? Starts with H, heroin. And there was a company a while back that pushed all sorts of opiates, right? But a Rush Limbaugh get caught with? Right, Oxy. which is basically synthetic heroin. This company has a painkiller that replaces oxycodone, and it's not a narcotic. You think in a world where we want to choke off money to Afghanistan, and we don't want people getting hooked on narcotics, you think this is a product with a good future? I do. I know several doctors who are putting big money into this. Now, I don't know if it can go lower. I think it can. But right around $11 a share, $10 a share, and right where we're at right now, if you don't have a position, at least sell a put. But start a position of 0.5% of your money, just 0.5%. Get your starter position. This is a stock that can go up 10 or 20 fold. Seriously. This market is enormous. And weirdly, it'll solve more than one problem. Company is going to be like any other company that's moving into the space. They're going to have to build their sales force out more and more, just like Exact Sciences did. Didn't hold Exact Sciences back. They will partner with somebody more likely than not. They just got all their approvals. 3 of them, I believe, this year. Everything that a pharmaceutical company needs to do is in process. It's all happening. So Discovery, take a look. Right back to where it's been. Now it's leveling off. This is Dr. Michael Burry from The Big Short's biggest position now, and I understand why. Combination of Warner and Discovery is going to be every bit as good. I mean, I think Warner's already every bit as good as Netflix and Disney. Add Discovery, and now you actually have more international reach than the other two, more content than the other two, actually as much content as the other two combined. Warner Discovery is going to be a big deal with multiple ways of offering streaming packages. You know, they'll have a light version, a normal version, and a have everything version, all you can eat. The other company here for you dividend investors, Viacom. Look at it chop along here. Now, can it fall down one more time? For sure. In a weak market, can it go all the way down to around 30? Absolutely. But I already think it's dirt cheap. It wouldn't surprise me to see NBC, CBS merge, right? Have Comcast spin off Paramount, right? Peacock. Just go right there. Kind of weird how these lines always end up with these jitterbug zones. There you go. It's in the buy zone. Can it go lower? For sure. Get rid of that. I didn't know that was drawn back then. A better system now. So can it fall down here? My guess, just looking at the waves, that it probably can come down here to the low 30s. But if you don't have a starter position yet, buy the actual stock that pays a dividend. Huge content library, assets that they can sell, easy to do M&A. Will it get all the way back up here anytime soon? I don't know. I think for sure it gets up into here. But remember, asset-light models. So if NBC and CBS merge, essentially, their studios, their distribution, now all of a sudden you've got a powerhouse. Viacom CBS is already pretty good. Think about the redundancy of some of the assets. The synergies between CBS and NBC would be off the charts. Then Comcast could just focus on internet, which is what they should do. The companies that should do something usually do. Just depends, does it take an active as an investor, a new CEO, some sort of kick in the pants, or do they just do it on their own like the AT&T management did? I guess there was an activist investor in there, Elliott. This is a nice chop along chart. Can it dip one more time? For sure. But I think you've got a nice ride up coming here. So I'd start to scale in if you're not doing it. Yeah, Viacom and Discovery look similar for sure. I'll finish up with this. Somebody asked, do you think the Delta variant could bring the economy down again? I guess the easy answer is I don't know. But if we go all the way back to the things I talked about last March and April and May, that we weren't handling things the correct way, I think that's pretty apparent now. The fact that we have Donald Trump getting booed at a rally in Alabama because he told them to get vaccinated tells you how big the mind fuck is on these people who won't get vaccinated. And the anti-vaxxer movement's been, around forever, but it gained some strength because of some of the things with autism that really aren't true, but people can blame something, they blame something. I don't think Delta's going to cause the same sort of problems that we've had so far, that we had last year. But I do think the supply chains are going to have periodic disruptions until we have most of the world vaccinated, which probably isn't going to happen for a couple of years at least. But there will be disruptions. They'll be short-term in nature probably, unless we get a variant that completely busts the vaccines, which would really suck. Scientifically, I don't know how to put odds on that. But the supply chains have problems right now. And a few years ago, when I was writing my articles about Trump's economic policy, and I said that a shock could push us into stagflation, well, now all of a sudden you have more mainstream people than me saying the same thing. So what happens if this reconciliation bill doesn't get passed? What happens if the debt ceiling doesn't get raised? Liquidity suddenly becomes a different type of issue. Does the Fed decide to keep doing QE and crush the dollar again and push it into that financial crisis zone that we've talked about? I don't know. Things are tenuous right now. And I think you need to keep an eye on that reconciliation bill. If it doesn't go through essentially as proposed, hopefully with some tightening up, they should add more clean energy. They should get rid of some of the pork. It's the opposite of what they'll probably do. The infrastructure bill isn't that big. It's only $500 billion, because they're taking $500 billion that they had already allocated and just shifting it. So there are a lot of problems. And the question becomes, how long can you run on semi-emergency power? I have no idea what that answer is. Anybody who tells you that they know, just lying to you. What I can tell you is that the quant factors, the cash flows, the liquidity in the market is coming down. Not fast right now, but it's coming down. And I think after Labor Day, and in fact, after Jackson Hole in the next couple of days, we're going to start to get a clearer picture. So if you have weaker assets, and by weaker assets, I don't mean, oh, I bought this stock at 12 and now it's 10. Don't be a dweeb. Most of dividend stocks and zombie stocks are still high priced. You have an opportunity to sell low growth assets right now and write covered calls at the money across almost everything else. Always buy it back later. And again, this pertains mainly to IRA accounts. I understand that the tax considerations in a non-qualified account are different, but I really urge you to get to a comfortable cash level because the unknowns right here are very high. And there are places to invest a little bit of money in super potential high growth assets. those $1, $2, and $3 billion companies, you know, you don't have to have many of those right. And usually most of them just chop along. But the ones that go up a lot. A company that goes from 3 billion to 30 billion, 10 bagger, right? Peter Lynch told us over and over again, you don't need a lot of those to pull the whole portfolio up. I've been giving you all kinds of potential 10 baggers. And will they all get there? No. Will several of them get there? Yeah. I say that pretty confidently. Several of them will. Buy the basket. Stop being flighty if you've been flighty. Control your emotions. Like I said, this chart right here, usually a little bit more down and then back up. Selling puts on these charts, pretty good idea. All right, let me get this published. I'm gonna head out to the Brewer game once the market closes. So I will get a retirement income options up first thing tomorrow morning. And if I can get it done today, I will get the Global Trends ETF report because Shooter did a bunch of those charts. All right, have a good day.